And I can raise my voice to really irritate them a little bit. I was in D.C. this past weekend with NATP tax forms, and Catherine Keene is speaking in the other room, so I purposely raised my voice. Her and I are buddies, but and somebody came over and said, "Could you lower it down?" "No, I'll just get louder, thanks." So it is all good. 4797, right? It is a form that I think drives us nuts sometimes. You know why it drives us nuts? It's because of the software. We're hostages. We're kept hostages by our software. Do we check a box? Do you put a 1 in a column or whatever? Who uses Drake? A lot of people. Who uses a Lacerte? Yeah, there's a little one. What else do we use? Pro Series, popular. How about Tax Act? Anybody? Yeah. I speak for Tax Act. Yeah. Who still does it by hand? Yeah, who remembers to do it by hand? I was in Phoenix, Arizona, and this guy had his brown suitcase, looked like Mr. Rogers, and he raised his hand. I'm like, good messing around. He goes, "No, really, I do about 40 by hand." I said, "What, do you start in January and get done in December?" Who does it by hand? I don't know. It's a smaller group. Ask questions. I don't care if I don't see. Are you teaching or am I? Okay, well, good.
It's CE.
I know. Yeah, I know. If you have a question, raise your hand. If I don't see you, just yell my name, okay? It's all about all of us in the room. It's not about me. It's not about anything. So when you sell a piece of property, a lot of times people just want to group it all together, right? They want to make life simple. They just want to put $1 million minus the basis, but you can't do that. Right? How many would say when you sell an apartment building that you had the Brady Bunch shag carpet, who says that has to be allocated out? Probably not, right? Because it doesn't have any value. And I don't know what lives in it might have value, but it probably doesn't have any value. But maybe carpet that you just put in, maybe 179 or windows, those things might have some value. That's one thing. You got to remember two things. 55% of the IRS workforce can retire inside of the next 5 years, really 4 years now. That should be scary to all of you, right? Because of the fact that we're going to have to train the new Skippy, right? Skippy going to be coming in and thinking he's all that. And one of the things he'd be like, "Hey, that's okay, sir. It doesn't irritate me. Just calls attention to you for walking in late." So it's all good. But we have to understand the allocation. We have to understand that these things have to be allocated out. How do we do that? We're going to talk about that today. So today's presentation is going to take you with baby steps, and it's going to get more complicated as we go. I firmly believe you have to know the old law and the new law. Most importantly, you have to know the software. Fourth and foremost, you have to know your client, right? But most importantly is you have to understand the basics. I will repeat myself. It's there for a reason. I'll challenge you with questions of which I don't even know. I'm hoping to get the right answer from you guys so then I could teach it better. But there we go. All right. Welcome. Everybody heard you come in, so it's just kind of a thing. Sioux City, it's a town of about 100,000. It's where Iowa, South Dakota, and Nebraska come together on the Missouri River. We're an old river town. We're an old rebellious town. When there was Prohibition, we didn't believe in it. We ran more liquor through Sioux City during the Prohibition than anywhere else. That is downtown. That's where my office is located. Quote of the session, ladies and gentlemen, is right here. The best way to teach your kids about taxes is by eating 30% of their ice cream. They have to understand early the concept of taxes. The other quote is by Warren Buffett, which isn't in your program today. And it says, "Accounting is the language of business." And I believe that because of this. I have a lot of people that call me and ask me questions. And I will always say, "What is your journal entry?" They're like, "What is my what?" Your journal entry, right? I have a degree in accounting, a degree in economics, and a master's in tax. Whoopie-woo, long time ago. The tax laws changed a little. But what doesn't change is the accounting. People need to be, us tax professionals, to be a great tax professional, I think you need to be a better accountant. My opinion only. Also, My airport code where I live is SUX for sucks, because it sucks to live there, I guess. I don't know. But you don't fly into Sioux City during tax season to sign my returns, nor do I sign your returns. You have to be comfortable, right? You have to be comfortable with the position that you take. And it is all about the code and regulations like we heard earlier, right? The code sections tell you the story, right? Who's old enough to remember Schoolhouse Rock, right? It's only a bill on Capitol Hill. I'm not going to sing it, but there's a reason. It's introduced House Ways Committee, and then it becomes law and becomes a code section, and then regulations tell a story. So we have to be comfortable with what we put in the tax return. So we're going to start, and we're going to go into things that you might not have thought of, you might have thought of, whatever it would be. If you got questions, let's get after it, okay? We're just going to talk about the form, but we're going to dig deeper than that, and we'll see what's going on. So we're going to do all this stuff and more, and you're going to walk out. So the most important thing, I think, when you come to class, there's a couple of things. Now, just so I don't want to offend anybody, I will cuss. That's just the way I am. Navy guy, that's what we do. But in class, I hope that you have an oh shit moment, because you're going to learn something. Yep. So that's my main objective. You got to remember, 70% of what I'm going to say today, you're going to forget. By the time you turn in that yellow ticket for a cocktail, you're going to be like, AJ who? Doesn't matter. But the goal is to keep notes, maybe come back and look at the PowerPoint, or give you one or two things. There's some pretty cool stuff later in the presentation. We're going to start, like I said, very basic and go forward. So, as we know, we have all these wonderful code sections that I still don't know what they mean. Look at this. This is funny. This is from 1913. The failure to have this return in the hands of the collector of the Internal Revenue on or before March 1st is $20 to $1,000. That was a lot of money back then. Yeah. 7216 is a bargain at $1,000 compared to that. All right, we got held more than a year, more than 24 months, short term, long term, 4 parts. It's all Greek to me, right? Sometimes we're like, where does it go? And believe it or not, even if you put it into your software, that does not necessarily mean it is in the right place. Sometimes we got to check a box. Drives you nuts. There's 2 purposes of the 4797. Sell and exchange a real property used in, look what's in green, a trade or business, and depreciable, amortizable, tangible property used in a trade or business. Couple of tools that we'll talk about later, couple of tools that you absolutely need. Really 3 tools that I didn't put the third one in. 1099-S, always important. Why? Sometimes the settlement statement, what we call the HUD-1 statement, if you're real cool, doesn't maybe have some additional details, but we got to be concerned with the gross amount. What if the 3 of us, so the 4 of us right here, we all own the piece of property together, we get a 1099-S, and it comes in my name? Well, I'm not letting you guys out without paying tax, but I'd probably put it on the return. Right, you can ask the attorney, you say, hey, can you issue 4 of them? They're probably going to go tell you to pound sand. Okay, so what I like to do is put it on the return and then say nominee to you 3 individuals, and you can do it that way. The best thing is always to get a new one issued, but sometimes they just don't do that. So please. And the third one that's not on the slide is make sure you get a copy of the purchase agreement or the sales contract. A lot of important things. You know what's important in that sales contract that we're going to talk about later is the 8594 and how to allocate those things accordingly. The 8594 breaks things down into 7 sections. We'll have that later. So here's what I love the most. Trade or business. We kind of learned this through 199A when they said that the simplest explanation is what's in the code for trade or business. It's not in the code. It's actually defined by the court. So when something's not in the code or when something needs to be defined, it's defined in the various areas of tax court, Supreme Court, or by the various circuit. Now, I don't know what, I know the 3rd Circuit is Delaware and New Jersey. What's New York under? What circuit? All right, good. You guys are from New York, right? That's where I'm at? Okay. 8th Circuit is Iowa. Right, if you find a case in a circuit that's in your area, that's always stronger, but it can be defined by anything. One thing that we learned from Trader Business or from 199A is Grotzinger. Grotzinger is actually a gambler. But what Grotzinger told us is the taxpayer must be involved in the activity with continuity and regularity, and that the taxpayer's primary purpose for engaging in the activity must be from income or profit. That is a quote from the judge. If it's not that, what would it be? It would be hobby, which wouldn't belong on here. Now remember, to have a Trader Business, you must be regular, ongoing, continuous. Activities must be substantial, profitable. We all know what it is, just sometimes it's difficult to actually define it, right? One thing I do a lot of representation. I'm hired by big law firms and big CPA firms. I'm very fortunate and lucky. One thing that irritates me the most, I don't get involved much with the local level. I'm only on appeals and tax court. But it's amazing what the auditors tell you that sky is pink, but we both know it's either blue or gray. And you should be a little worried about the new auditors coming in. And I will tell you, to be nice to the new auditors, the more time you waste with them, the less time they have to worry about that. Now, you might think that's naughty. It's not naughty. It's just good business. They will remember you being nice. No need to be a jerk unless you absolutely have to. We have to remember that we have to divide things up among 1231 assets, right? 1231, which I'm going to tell you about 5 times, is a category. It's the form of asset held more than a year in a Trader Business. Then after you sell it, we have to then recategorize it into different categories. Is it ordinary income? Is it capital gain? Is it inventory? What exactly it is, and that's what we're going to talk about. We go into the code section. The simplest part of what you're going to do, or what this class is determine the gain or loss, which Code Section 1001 essentially says, right, what it says, amount realized minus a tax basis. What we do after that is when it becomes complicated, right? Do we have ordinary income? Do we have capital gain? Is an inventory? We are going to discuss all that. Here's a chart which makes absolutely no sense. I will put it in again towards the other. We got to remember, Trader Business held more than a year, 1231. If it's a gain, you follow a path. If it's a loss, you follow a path. But like he said, if it's a gain, was there any prior 1231 losses? We'll explain that. The remaining gain, 1245 depreciation, ordinary income. The remaining is 1231. We have 1250 gain, 1231. All these things in the box we will discuss today, and it will be easy peasy at the end of the day. Sales price, as we know, is the amount realized. Recently had a client come in, and he said, AJ, I sold the piece of property for $100. Like, you're a moron if you sold it for $100, because that's all I got. I go, what about the liability on it? He goes, oh yeah, they assume that. That is assumed by the buyer. That's part of the sales price. Fair market value of any services. We have to ask questions. Just because it's not on the 1099-S or the HUD settlement statement, we have to inquire. That's why the contract is so important. Then, of course, we have basis. We all know what basis is, right? The original price plus assessments, capital improvements, restoring. Then we have to, of course, decrease. How about insurance reimbursements? Right? A client had a rental property. He called me and said, last windstorm, my garage on the rental property collapsed. What? He goes, it was in bad shape anyway, but I got $20,000 for it. How much tax do I have to pay? Everybody asks that question, right? In this case, I gave him good news. It's nothing. Why? Because it reduces the basis. It's in our old world, we called it salvage value. You reduce the basis. Now, if there's no basis left, then we would have a taxable deal. That's why. Does anybody, I know this question to be crazy, but there are big firms that do depreciation schedules outside of their software. Does anybody do that? Yeah, you do. Yeah. So you have a depreciation-only software. Yeah. At first, I used to make fun of that, but when I saw that with the national firm, it actually keeps track of a lot of cool things. Which program do you use? Okay. They have a separate module. Yeah. And they can keep things, it just is a little bit neater. But, all right. We have other issues. Gift property, the lower of what? Cost or fair market value. If somebody gifts you something, it's the lower of cost or fair market value at the time of the gift. When you sell that property, if you'd like to go down a rabbit hole, just read those instructions and have fun with it. Inherited property, at the time of death, they get a stepped-up basis. That's why sometimes I have a 93-year-old client that has 2 homes that have appreciated over $800,000. He goes, what should I do? I say die. He doesn't like that advice. I think dying is the best thing he can do. He's 93, so we're not too far off. So my clients love me. My clients love me. How about change from personal use to business? You have a guy that is a contractor. He comes in and he says, I'm going to go out on my own. What do you have for tools? I haven't bought any. You have no tools. Well, I have the ones in the garage. I said, well, make an inventory of them. Tell me what they originally cost and what you would sell them for legitimately. It would be the lower of, so it's actually going to be the fair market value. But there's got to be some value there when they bring them in. Don't go crazy, please. This is a chart that I hope you print and put in your whatever file. Laminate it, right? I love this chart. I designed it so you can copy it and do whatever you want with it. But this tells you, because at the end of the day, how many doesn't review their tax returns? Nobody should be hands up. I'm all by myself, so whatever. I've got a pretty good audit rate. No, I'm kidding. Whatever I do today, I will review the next day or the day after. That's why anything comes in after April 1st, it goes on extension, because how many brains are working properly on April 1st? Right? Not very many. Not mine anyway. So I'll be happy to say that I'm actually taking a vacation in March. I've sold the majority of my practice. I've kept about 50 clients because I'm not going to be up here talking if I don't know it. So I've kept everything from earned income tax credit to the guy that makes like $40 million a year. Most of the stuff is high end, but I am not going to work that hard during tax season anymore. So everybody should have an exit plan. I was lucky enough to find somebody that wanted to grow their business. I did not argue. Actually, 2 different people, so they went elsewhere. So let's look at this. We're all 3 met. Let's just think about land. We're all 3 met. Depreciation taken? No. Long-term, yes. Disposed at a gain? No. Not all 3, right? Was property used in a trade or business? Yes. Property held long-term? Yes. Report in Part 1. But if you put it in the tax return without marking the right boxes, it's probably not going to end up in Part 1, but land always goes in Part 1. My favorite part of this chart is outside the discussion of this class. But the easiest section is knowing what? Depreciation taken, long-term, disposed at a gain, Part 3, 4797. The next few things are just there for your reference. We're not going to go over them because you guys can read it, right? Where do they go? Held 1 year or less, held more than a year, et cetera, and it helps you. And then I got one later on that actually will tell you what code section it is. I've put a lot of time into developing this chart. No, it's right in the 4797 instructions. I just copied and pasted them, but it's pretty good reference. Believe it or not, what the IRS does well is their website and their instructions. But you got to remember that instructions are not substantial authority, nor are publications, which IRS agents. I remember reading a report recently for an appeals, and the agent quoted publication 17. I had fun with that in appeals, but probably made the guy cry. Where does it go? Part 1, long-term or sold at a loss, land or non-depreciable assets. Eligible capital gain from Part 3 is carried to Part 1. Most importantly, what I always like to say, sorry for going back so quick, is this chart will assist you. You think, I don't need a chart because I have software. The software is not as smart as you are, right? Sometimes even I call the software company and say, are you sure about that? They get it right a lot. Do you know this? The IRS only signs off on a handshake with the software companies to ensure that I'm talking to you. You're a software company and I'm the IRS. Do we talk to each other? Yes, you're good to go. Do you know that the software starts from the instructions? So the software doesn't even start from substantial authority, but that's how they do everything. Because if you talk to a programmer like in Drake, your K2 and K3 program in Drake, I hope you love it because I am the mastermind behind it. I did not program it for the love of God, but I told them how it should look, right? And oh my God, programmers are a rare breed, a lot smarter than I am. One finally told me, then you do it. I don't know how to do it. I'm just telling you how it should look. But by using this chart, you'll understand what, and then by following this, you'll understand where it goes. The importance of how it gets there is tied in with the code sections. So that's why I always say be very careful, especially with 7203, the basis, or 7206, the health insurance. We have a new form out. If you don't know about it, it's called the 7217. It deals with partnership distributions, but I'm going to give you good news right now. Only for property distributions and not cash. I don't know when the equivalent to 7203 is going to come along, but the 7217 is only for property or security distributions. Part 2, all ordinary gains or losses. Accumulation that comes maybe from Part 3 when you divide it out, because remember, anything that's been depreciated up to the gain is ordinary income. Part 3 is where you want to put everything. I call it the cool guys section. Everything. It's amazing. Like when I said, when you sell that rental property, you want to put everything there. It's a lot easier, AJ. I get it. It's not that easy. Part 4 is the only part that doesn't deal with the sale of property. Here's the deal. You have a client that has an automobile that he took 179 on, and then he gives his automobile to his daughter to go to college. So now the use fell below 50%. What happens? Well, 280 cap F dictates what happens. If you took 179 on that vehicle, okay, and then you give it to your daughter, just tell, you give it to the daughter, and it's, let's say, after 3 years. What you have to do, let's say the vehicle cost $5,000, and let's say you took all of it. It was a truck or whatever. Well, now we take depreciation over the 5-year rule, and we determine that only $3,000 should have been taken through 3 years, hypothetically, which means we have an acceleration of $2,000, which has to go back onto, let's say, the Schedule C. But here's the kicker. That recapture is subject to self-employment tax. That actually goes right back onto the form. That's a crazy part to even think of. And remember, when you sell that piece of rental property, I'm just going to use rental property as an example, what do you have in there? You have 5-year, 7-year, 15-year maybe, 27.5-year. All those items have to be separated out if they have some value, and we'll talk about that in sales allocation. So don't forget about Part 4. This will kind of get us. Okay, let's go. 1231. Now, why do I have an umbrella? Because 1231 is the keeper, right? That is the character. That is the main guy. And then it's characterized after that. So then we have 1245 and 1250. 1231 is the cream of the crop. Sale of business assets. But the cool part is the net losses are fully deductible as ordinary losses, and they can create an NOL. But we've got to be careful of those losses, which I'll explain. Capital gain treatment when sold at a gain, held longer than 1 year, real property depreciated or not, held more than a year. Here are some examples. Buildings, machinery. No, wait a minute. Buildings, land. Some of this, remember, it's 1231, and then 1231 after 1231. So let's put it this way. When you sell something, you look at provision 1001, which tells you how to figure the gain. After that, then you determine what type of property is it. Used in a trade or business over a year, then becomes 1231 property. And then from 1231 property, we have to determine, is it 1245, is it 1250, 1252, 53, 54. We're not going down those rabbit holes. Timber, natural resources, unharvested crop, land, right? This is where the 24 months come into play. Unfortunately, livestock does not include the ones listed there. So frogs are out. So, all right, leasehold that are at least a year old. It does not include inventory or property. Inventory is classified under 1221. or it does not include patents, inventions, musical, artistic compositions, letters, things along that nature. Anybody represent any musicians? Yeah? Anybody popular? Oh, just okay. And did they write their own songs? Or that's cool. Okay. What is 1245 property? It's depreciable property sold at a price in excess of the value may, the key word is may, get favorable treatment, which we know all of this. But what is 1250 property? How many's been practicing since 1987? Don't raise your hand, that's embarrassing. Just say, not me. No, of course we have.
How about 1968?
I can't help you. Who has practiced less than 5 years? Anybody? Yeah? All right, what'd you do before? The IRS? I love those guys. I don't. How long were you at the IRS? 20 years. So you get a pension. Yeah, were you agent, officer? What were you? Agent. So you're in trouble now. I was at the IRS tax forms, and I was managing the IRS examination, and I said to the crowd, I said, you know what irritates me the most? Are managers, group managers. They're idiots. I said that in class. I said, why? Because they have an ego, and they don't know how to say no. And the agents it's like the apple doesn't fall from the tree, right? You're limited on what your group manager does. And I said it's all an ego. So I also said, when I went in appeals, I loved to send them a love note back and said, please don't waste the taxpayers' time. So this guy comes up and he said, hey, AJ, how are you? I'm like, good. He goes, I'm the overall manager of the group managers. I'm like, there goes my license. But he agreed with me. He goes, why do you think it is? I'm like, I don't know. I don't know. They got a participation medal. I don't know why they don't like no, but they know that that's a problem. So, I don't have any problem with saying that, but when he came up and introduced myself, I'm like, oh boy, all right, but it's all good. So 1250, we might not see it all the time because to the extent accumulated depreciation exceeds straight line, which is what? Acres, right? How about a brain quiz? How about a brain teaser? You have qualified improvement property, right, under the CARES Act. We'll talk about that later. 15-year property, it's technically 1250 property. So it's 15-year property if it's an interior portion, it's non-structural, and it qualifies for bonus. So you take bonus, and then you sell it before the 15 years is up. Would 1250 come into play because you use something in excess of straight line depreciation? Because bonus is what? Well, 60%, or 179. Even certain things qualified under the Tax Cut and Jobs Act for 179. So is the 179 in the bonus, would the old 1250 come into play? Well, okay. Thank you for bringing that up. So he said, if you didn't hear him, I thought it flipped to 1245. Not necessarily. QI, qualified improvement property, still maintains the original 1250 character. So it still maintains, it might dress like the wolf, it might dress like a 1245, but it's still 1250. So it's an interesting perspective. Not all, but then you really want to go down the rabbit hole. Not all, but some does classify itself. But in general, it's still 1250 property. This just came up in a big case. I say that it does, that 1250 does come into play a little bit, but to stay tuned because it's being battled out right now. But see how much fun you can have? Oh my God. So here's a very simplistic example of what I'm talking about on 1245 property. We all know this, but sometimes it's good to look. We purchased it for $200,000. We had accumulated depreciation. We sold it. We have a $100,000 gain. So when we go to that flow chart, held long-term, depreciation sold at a gain, we know it goes to part 3. But of the $100,000 gain, $55,000 is ordinary income. So when that client calls, said, AJ, I just sold something, and you look at it, You got a $100,000 gain, you're like, it's $15,000 tax. They live in South Dakota and there's no state tax. But when he comes in, or she comes in, you realize that $55,000 is ordinary income, probably above the 15% or less. And then the remainder, we got to be careful on how we answer the question. How many of like it when clients call, what's a standard deduction? I don't care. That's where I like the computer. Again, what is the difference? Well, the main difference is 1231 is the category. It categorizes what type of property it is. Held long-term, used in a trade or business. Okay? Remember, 1231 losses are fully deductible, unlike capital losses, which are what? Limited, right? But remember, after we sell the property and we go through all the provisions, we have to understand that we have recapture that comes into place. But when we have a loss, it's fully deductible. Come on, there we go. But we have to be aware of what we call the 1231 trap. A lot of people. How do I relieve my stress? 2 in the morning, I put cartoons into my, don't worry, I don't steal them. I have like 3 different subscriptions so I can use the images. Because some people will ask me that. Do you have ownership of it? I didn't design it, but yes, I do have the right to use it. All right, 1231, that has been deducted as a loss in the prior 5 years, has to be considered. So if you get a new client that has a business, you got to go back and look at 5 years. I had somebody call me once and said, AJ, what are these numbers under 1231? It was a new practitioner. I'm like, oh, they're tracked. The software will track it, but if you have a new business client, you always want to see 1 year, but you want to see 5 years. Okay? Because if you had losses previously, what did you get to do with the loss? Fully deduct it. So there's a little provision that prevents you from doing that because people were being naughty by maneuvering to secure the ordinary loss treatment, and then of the assets just to be sold as a loss, they would sell them in 1 year to get a fully deductible loss, and then to the next year, then they would sell the capital gain. But the 1231 loss provision prevents this from happening, jumping over the shark's teeth. Here's a very simple example. You got Beth, had $20,000 gain, but after reviewing the last 5 years, she had taken $5,000 of losses. So those $5,000 has to be categorized as ordinary income. Why? It's the provision under Code Section 111. It's the tax benefit rule. They gave you, they will give it back. The remainder of it goes to Schedule D, subject to the capital gains rate. Again, if you pick up a new client and you don't have the last 5 years, this could be a problem. Not that you're going to ask it, but I got asked this question recently. What if you have a husband and wife and they have separate businesses? Okay, and I answered that very simplistically by saying, if you have a husband and wife and you had capital losses, do you separate them? No. So it stays with the return, but if one dies or divorced, then they go their separate ways. But if they're part of the return, it stays with the return and it doesn't matter. Doesn't differentiate. And you go, are you sure? Like, yes, I'm sure, but better yet, look at your software, even though we shouldn't assume that it's right. They don't say it belongs to the taxpayer's spouse, it just has a separate category for it. Okay? Yeah, then it's gone. Yeah, it goes with them. No, it can go away. It's part of the returns. Think of it as a capital loss as part of the return. Thank you. But if you look at the return, remember this. We're American tax experts. We're not data entry people. People ask me all the time, the IRS doing direct file, is that an infringement of our work? No. Wherever you live, even in Iowa, where we just got indoor plumbing, like, you guys got plumbing? Yes, we got plumbing. Not very long. Pandemic, we got it. they'll ask where, or I just lost my train of thought. But anyway, what you have to determine is if indeed you have losses, right? That's what I want to do. People ask if it's an infringement of our business. No, wherever you live, you have a Home Depot or a Lowe's, and you also have contractors. You ever try to get a contractor? They're impossible. Contractors never have any time and they never have any money, but they're always busy. Like, why do I owe tax? Why didn't you pay the estimates? I don't know. It's a pretty good trade-off, right? So I don't believe, right, we are not data entry people. We're tax professionals. Direct file is not, to me, it's not an infringement of our business. But that's just my opinion, of course. But also, if you look at this, and let's say all the losses were 4 years ago and somebody wants to sell anything, but this number is significantly larger, just wait an extra year and all that goes away. And once it goes away, like in this case, it's gone for good. It doesn't keep going for the 5 years. It's gone. Okay, examples of 1245 property, as you can see on the screen. I have grain storage bin, but one thing I should point out, they got to be what we call in the Midwest single agricultural single-purpose item. They store grain, or they store beans, or they store something, marijuana, or something, right? So, when did it become legal in New York for marijuana? How long has that happened? Yeah, it was weird because every time I go to Manhattan, I have a client there, and it's just like the streets are like, yeah, it's crazy. I'm like, oh, yeah. You don't even need to smoke it anymore. You can buy a gummy bear. Like, all right. I walked into I call them a head shop, but man, that's because I'm old. But I walked into one just to see one, and this young kid, he's like 24, and he's stoned. He goes, dude, this ain't the pot you used to smoke. And I go, how'd you know I smoked pot? Everybody did back when you were young. And I'm like, what the hell? Okay, just smoke another one, dude. It's just be in the area. I'm telling you. Examples. Now remember, 197 has the same principle of depreciation recapture as depreciation. Amortization is the same principle. You just call it, instead of 167, it's 197. 1245 property is not land or land improvement, nor its buildings or inherently permanent structures, nor its structural components. Or is it? We'll talk about that in a second. All right. Remember, 1245, once you determine it's 1231, 1245 says any gain, we first look at the accumulated depreciation and it has to be ordinary income. Why do I have these silly cartoons on the screen? Can you move these things without causing damage? Well, it depends if you never drove a tractor, maybe, but you can move these things without causing damage, hence they're 1245 property. All right. Now, Sally is a farmer. Let's just go to the next one, make it life. I won't spend a lot of time. But what happens if the gain's only $1,800 but depreciation is $13,800? Nothing. It's just the $1,800 is all ordinary income and there's no capital gain. It's very simple. But what happens, which has happened lately, I have 3 farmers. A lot of people think all I do is represent farmers. I have 3 farmers. One is that my largest client is returns well to the excess of 300 pages. He just had a transmission replaced for $91,000. Oh, you don't even want to know what a new one cost. But things are selling for more than sometimes they bought them for. In this case, they sold it for $24,000. Now, only $13,800 is accumulated depreciation. That's ordinary income. And then the remainder is capital gains. But you always have to look at the recapture of the depreciation. Don't forget that. And it's good. Why am I going over these very basic things? Because the software sometimes doesn't get it right. That's why that flow chart at the beginning helps you understand when you print it out or you look for it on the screen, is it right? Yes, sir. We'll get that. We got that coming up. And if I don't answer the question, yeah. If I don't seem to answer it, then you raise your hand back up. Thank you. Okay. 1250 property, like anything in the code, it's whatever, it's not 1245 property. I love definitions that are, well, it's whatever, it's not 1245. It's real property. Structural components of the building. It's land. Parking lot, we'd all agree it's depreciable, 15 years, right? But is it 1250 or 1245? Part of land, right? So what's land if you buy a rental property and you have the building and the land? Land's 1250. They're both 1250. But you got a parking lot, it's 15 years, it's 1250. No, it's not. Well, kind of. Court case, very, very cool court case, essentially came in and said, there's a trucking company had a distribution center. And the distribution center put a parking lot on. The judge says, well, technically, that's a vital part of the business, so it's 1245. Which hurts them tax-wise, because 1245, it's ordinary income, but so is 1250, but it's subject to a max of 25%, and if you're in a 12%, then so be it. If it's vital to the part of your business, it says this in the court decision, then it's 1245. If it's a retail shop, it's not vital. I don't know. If you're a retail shop and have a dirt or busted up parking lot, I don't know if your business is going to be coming in for you. As anything in here, it is pretty interesting on how things can develop and how different case law. Every morning, I challenge everybody, every morning you should read a tax case, something that comes down the pipe. One, yes, I don't have a life, but it really rings true on what's happening. 1250, it's a little bit different than 1245. We have to recharacterize depreciation as ordinary income, but with a catch. It required the recapture of prior depreciation in excess of straight line would have been. This is 1250. See the difference? You can't quite take it with you unless you're Superman. But after the Tax Reform Act, starting in 1987, we have makers. Makers requires everything under straight line, so we don't have the excess of straight line and thus no ordinary income. Because 1250 actually had three provisions. The first provision was, what was the excess over straight line? What was depreciation, which then would be subject to 25% maximum, and then the rest of it goes to capital gain. You have to go way to Section 1, requires a taxpayer to take an additional step. So now, under 1245, everything is ordinary for the depreciation. All depreciation is subject to what we call unrecapture, right? And if somebody could please tell me if unrecaptured should have a hyphen there, I don't know. Somebody said, shouldn't that have a hyphen? Don't really care. Wasn't an English major. So I have a friend of mine who is a CPA, and I think they were an English major, because I think he lived in his parents' basement for a while. No, I'm kidding. So to be naughty, when I write a brief, we kind of exchange it. I put commas like every other word. Drives him nuts. It's like AJ. If I don't put a comma, he goes nuts on a comma. But, oh well. All right, so why do I have this little box? Think of it, not the handle. You can't look it up by the handle. But everything in the box that you can take out is 1245. Anything that stays situated and adjusted to the floor, let's look here, right? That's why, I don't know if we'll get to it, we talk about cost segregation studies, right? We call them cost seg to be cool. We talk about if you bought the hotel, it's 39-year property. But you probably want to do a cost segregation study. Can you remove the chandelier? Well, I couldn't, but you could move it without causing damage. We can move the ceiling tile. You can remove this, right? But if we removed a main pillar, we could even remove that. So if you can remove it without causing permanent damage to the structure of the building, it's 1245. Otherwise, it's 1250. That's the implication of my neat little cartoon there, okay? What else? Again, real property, land, anything growing on the land, any structures permanently attached to it, 1250. I get this question, I'm just going to get it right now. Personal property, all property that is not real property. Personal property is, in essence, a word. Not just like, well, if it's personal, how can it be depreciated? No, just meaning personal property that you can touch and you can remove. That's 1245. Not personal in the sense where you don't use it for a trade or business. Why did they use that word? Why does the IRS call the sky pink? I don't know. No offense, sir. You got your pension, be happy, right? I'm going to pick on you, just be happy. You get a pension, we don't, right? Yeah, so, all right. Were you in New York the whole time? Yeah, very cool. How long have you been since you've been retired? 7 months? Oh, okay. Did you, like, when you were ready, you were ready? Yeah, okay. You didn't want to, like, hang out, go longer? Okay. Then you got your EA, right? They give you the EA? Very cool. I always say this, and I mean this sincerely. He had a job to do, right? You might have called him names, you might have done whatever. Look at him. How could you be mad at that guy? Look at that face. He's just like this lovable guy. I bet you he wasn't, though. I bet you he was kind of an ass. But what you did, yeah. I'm talking here. Okay, we'll talk later, okay?
You don't think she cares.
But he had a job to do, right? You had a job to do. End of story, right? There's no need to be a jerk to him, right? I always say this, that you need to take that chair and move it to his side of the table to see how he does his job. That way you can do it better. Never be an idiot to the agent, because, one, they can be idiots back, and that's never going to end well. But just be nice, right? Don't overpromise, and I'll talk about this tomorrow in my representative kid. Don't overpromise and underdeliver, right? Be nice. Simple terms, yeah. Oh, I know. He says true, yes. All right. Again, here we go. We just have the different chart. I did make this chart up. Just tells you what the code sections are to help you out. Some people live on code sections. What's 1231? When we know cash is not, we know accounts receivable is not, we know inventory is not. Right? Inventory is in 1221, normally to the course of a business, right, if you sell widgets. Everything else probably at 1231. And determining if it's 1231, is it amortized, is it depreciated? If it's depreciated, is it 1245 or 1250, et cetera, et cetera. So, sir, in the suspenders, we're going to get to your little thing here. Now we're going to get to the fun part of the presentation. The first part is like laying the groundwork, very basic information. Now we're going to have some fun. Client comes in, says, AJ, you're going to be so proud of me. You know that's not going to end well. So he says, I sold, so he had a number of Bobcat, he had a construction business, right? And he had a number of Bobcats. I got to tell you Catherine Keene's story. It's kind of funny. She calls me up, and I'm out of breath. She goes, why are you out of breath? I'm like, well, I had to get the dog in because there was a Bobcat in the backyard. She goes, why is the dog afraid of a piece of equipment? And if anybody tells her that I told you that story, I'm gonna deny it. She goes, like a real Bobcat? Like a real Bobcat. Stuff's crazy here in Iowa, yeah. So he sells these Bobcats. He's all excited. 17 of them, or maybe more. A crap ton of money. He goes, you know the best part? I got $5,000 down. I got 10% interest. I'm like looking for a bag for him to throw up in. $300,000 of accumulated depreciation. I'm like, guess what, dude? You got to pay tax on that. Like this year. Because $1,250, you're okay. $1,245 is recaptured in the installment sale in the year of sale. $1,250 in excess of straight line is not $1,245. It's still $1,250. But because they bought him doing acres, the 40 years should be up. No. That's a good question. So the 40 years should be up, so there shouldn't be any. Right? Yeah, because I've been on a high school. Well, no, you could still have, because it'd be 40 years. 40 years. 1986 was the last year, and it's 40 years straight line. So you still could. Yeah. A lot of times people ask me questions on how I handle things. I'm like, just fire the client. 'Cause sometimes they ask you questions, you're like, fire the client, you know. So, be very careful of this. The guy, like I said, I'm down to about 50 clients and about 15. He's no longer a client, but I still see him and I still make fun of him. Because he was so proud of himself, you know, interest rate high and yeah, okay. Whew, don't forget that. Standard mileage rate. This is something we sometimes overlook. So what happens? You don't want to depreciate a car, so we use standard mileage, right? So what happened in the Tax Cut and Jobs Act? No more personal property for like-kind exchanges, right? So if you sell something, if you trade something in, that's still hard for people to get. If you trade it in, I need to see the trade-in value. I just traded it in. Well, I need to see that. If they use standard mileage rate, you have to recap this 30 cents up to the cost of the car is ordinary income. Who does that? Don't say you got a revenue rate. He's retired. It's all good. Did you ever look at that in an audit? Not really, heck, not really. No, you didn't. Okay, you didn't see that part of it. Okay, so were you always a revenue agent? Okay, his name was Griff Anderson. He's passed away now. One of the best revenue agents besides you, I'm sure. And I asked him. I said, he had the pocket liner, the black glasses. I mean, you look at nerd. He was it. Smartest guy I ever met. And I asked him. I said, why aren't you an appeals officer? He said, simple. I don't want the headache, and I like doing what I'm doing. God bless him. So I remember one time, I'm going to take this for a second. So we're like getting lunch, and I went to pay for him, and he goes, AJ, you can't do that. And he's like giving me a lecture. I'm like, good. So when Griff retired, he lived in Sioux Falls. When he retired, I drove 88 miles and took him to lunch, and I paid for it. He had a limit of $10, but no. But what a nice guy. He was tough. I didn't have to deal with him too often, but he was fun. So remember, standard mileage rate, you have to recapture that. Now remember, let's say your car has 180,000 miles. You continue to take the standard mileage rate, but I'm sure the depreciation part of 30 cents is gone. You just don't keep accumulating it. That only accumulates up to the original cost. Okay, my favorite topic of all time, and yes, we got plenty of time for it, because we kind of buzzed through the other part so we can have more time associated with this. Partnership. Anybody familiar with the 751? All right. Easy back there. Got to throw off a shoulder. Okay. So here we go. Ready? Taking notes? Here we go. All right. So, two brothers. Honestly, two brothers. All right. Which you might think, what's that got to do with anything? It does a whole lot to do with something. So, have two brothers. And we have, it used to be Iowa Beef, now it's Tyson. We're one of the largest beef processing plants in the United States. So we need a cold storage, right? It's where they take the meat and store it before they ship it all over the place. So I have a client, him and his brother, they build cold storage units. So this company was going to build one. And they go to the two brothers and they said, we don't have the money to pay you, but we'll give you a portion of the partnership. Okay? Now remember, when you exchange services, such as they did, they got a capital profit loss, they got a full ownership interest. That is taxable income based on fair market value when they put it in. It has nothing to do with 751, but we're just laying the groundwork. So they recently sold it for like $6 million, their interest, right? Their 8% interest. Client comes to me, so how much do I owe? I'm like $2 million more than his brother. So his brother says, I'm going to go with my brother's accountant. I'm like, let's get a meeting. Well, why is there a difference? This is so important. When you sell a partnership or limited liability company interest, you have to take a snapshot of the balance sheet as of the date that it's sold, and you have to assume that it's liquidated. What does that mean? So I got to call Skippy up, right? The young accountant at the big accounting firm in Minneapolis and said, hey, you got all my disclosures. I need to see the depreciation schedule for the cold storage unit. Skippy says, Mr. Reynolds, why do you want to see it? He goes, it's a true story. I go, I need to see the hot assets. He goes, we're in a cold storage area. Oh, Christ. Where did you go to school? Went to Duke. Okay, good for you, dude. Never did like him. I'm like, no, I need to know because I have to back those out, and then I have to take, so I said, just give me the depreciation schedule. He goes, no, I need to know. I'm like, I'll explain it to you later. So we take the depreciation schedule, which was on a separate thing like you have. Okay, then I have to take it to an outside party. We're talking a lot of money, and I have to then analyze what everything is worth. Why? What happens, as we just talked about, when we sell that? If we sold it, what do we have? It's 1245 property, right? Most of this was 1245 property. We have recapture of depreciation as ordinary income. Well, the other accountant for the brothers said, AJ, we're selling it. It's a capital gain. No. 741 of the Internal Revenue Code is like 1001. It tells us you take the basis, subtract the basis from the sales price, that is your gain or loss, unless you have 751 hot assets. Unrealized receivables. We don't have any accounts receivables. Depreciation recapture is an unrealized receivable. They were on a cash basis. What else did they probably have? Accounts receivable. And there's a revenue ruling from 1965 that says that is subject to self-employment tax. Not only do we no longer have a capital gain, we have 1245 recapture, ordinary income is accounts receivable, and then capital gains. Hence, my number is a lot larger than that. A lot of you say, I don't represent partnerships. However, you represent people that have publicly traded partnerships. So next year, how many people have like EBT or EDP partnership and things like that? Look at the K1 on the last page, the pages you never look at, and it will have a statement stating if the member on the front page sold their interest, take the amount of ownership times this number, and that is your 751. You got to remember that the 751 portion means that they got to recapture, that you take a look at it, you snapshot it, and consider it to be liquidated. The hardest thing that's going to have to happen is you're going to have to determine a sales price for all the assets, which means it's going to cost the client money, but it has to be done. So people then say, how the hell are they going to know? It's pretty simple. What do you have on the K1? 20%? What do you have on the K1 at the end of the year? 0. You also got to check a box that says that it's been disposed of. You also have to, and you know what else they're going to get you on? Is not filing the 8308, which is like a 1099, which says, Mary bought it from me, or whatever, as the buyer and seller on it. In addition, you give me your card and I can give you the right language to put on there. In addition, you got to put language on the K1 for the partnership that you're representing. Do you represent the partnership or the partner? You need to get the depreciation. You need to get a disclosure and get the because that your client is entitled to the depreciation schedule. You need to get the. Yeah, you got all that. Oh, what do you need me for? Yeah, because it's a recapture of that. And so, in addition to that, you have to put a disclosure on his return. On the personal return, you got to do a 1.751 disclosure. How are they going to know that? So, we in the industry call them LBIs, large business institution, or LBI. They are practice units on how the IRS audits it. Are they substantial authority? No. You ever use an LBI practice unit when you audit somebody? They're a gold mine. And the Internal Revenue Manual, the Audit Technique Guide, and the LBIs, the practice units, defense wins championships, right? My kids hated that when I said that. But that's how they look at things. So by remembering, a lot of people say, well, nobody's going to know. Like last year, who's going to know? You're going to know because they're going to, that it goes from 20 to 10 or whatever. Now you have 751. That's a big deal. Did I give you no shit moment yet? It's good for you, because a lot of people, there was a huge difference. And the other accountant is like, I still disagree with you, AJ. I don't care. I'm not doing the return. Here's another kicker under 751. There's a 3-step process, not a 751 class. I'm not going to dive too much into it, but there's a 3-step process on how it works. You can have upside down 751s where you have ordinary income and then capital loss at $3,000 a year. Yeah, try explaining that one. I mean, so 751, you got to remember this. Subchapter K of the Internal Revenue Code is the shortest code section in the code, but it's the most complicated. Why? You got 754, 43, 34, 41, 51, all of that. And you got to remember, think of this. How many represent lawyers? Yeah, they'd love to tell you how to do your job, right? You'll appreciate this more than anybody. So you can't believe how he's shaking his head. So one of the main partners retires, and he did the tax return. So I get the tax return, and they're like, AJ, and I do trust and estate work for him. Can you do it? Well, I get the partner's capital accounts are like $7 million, and they have $100,000 cash in the bank account. They never put distributions. So then I have to adjust that. But the problem is having them understand that you now are the tax guy and they have to listen to you. But when partners leave, they get paid out a formula. It's a weird formula. But part of that formula is accounts receivable. And that accounts receivable is 751, and it's subject to self-employment tax. Then if it's a redemption or a sale, then we got to worry about 1250. Not going to go there because he's going to be like, what the heck? But 1250 on recapture and capture. And then you have inventory when it's more than 120%, and it depends whether it's a redemption or a sale. So it's a lot of 751 is it's okay. No. I do a 1-hour class and a 2-hour class. I love doing a 2-hour because I break it down by like 4 different examples, really 5. But this is the area that I know we're spending more time on it, but the front part of the presentation is there for you to look at. We all know this stuff. Now we're getting into the stuff that look. You know what I love about this practice, whether it's new or you're a revenue agent or whatever, you get humbled every day, right? Mm-hmm. My grandfather always said, never be the smartest person in the room, because if you are, you're surrounded by idiots. I am not the smartest person in the room. Not even close. I just don't have to pay for it like you guys do. I'm just kidding. But I love to come and talk about it because we all learn from each other. It's checking your ego at the door, and we all learn from everybody else, whatever it might be. You have a question? Go ahead.
Yeah, well, I don't know why I get lawyers and accept them, but I do.
It's primarily my practice now is lawyers.
One of my law practice clients, they hate each other, so they're all splitting this year.
Okay.
Now, I don't have to worry about this. They're all going to take a piece of everything.
Yeah. So one thing is cool, when a partnership goes away, right? When it goes away, I'm going to touch you. It's okay. I've already touched it once, so you can sell it later at auction. Like AJ touched it. It's like an Elvis scarf, So they all go away, and the basis goes right with them. Then when you sell it, then you have the issue, but not until then. But remember, just a side note, you brought it up, I might as well talk about it. When you go from a single member to a multi-member, or a multi-member to a single member, or LLC, single or multi to an S corporation, there are usually no tax implications because basis follows. Remember, when you go from an S corp or a C corp to something else, it's assumed to be sold at fair market value. Be very careful what you put in these corporations. You say what he... Just tell them, just find them a picture of somebody putting on shoes and say, you're just stepping into the shoes, right? Okay. Another thing you got to be careful of We okay on the 751? If not, I'll be at the gala tonight, so if you want to ask me more questions, I don't mind. Oh, I mean, if you want to discuss something. Or, okay. Yeah, no, that's good. I love to talk about it. All right. When you, my favorite, I should not say this, so I did not say it, but you're retired. You ever you sell something and you're in a hurry and it's April and you're like, the 179s have to be separately listed, but it's been 7 years, so it's fully depreciated. Accumulated depreciation. Remove 179. No, you shouldn't do that. Have I done it? I'm not going to say yes or no. But why? Yeah. Why do you have to list them out separately? So when something's sold on 179, you always have to look at the sheet. So if you have 1231 assets anywhere on that K1, look for an additional sheet. 179s are listed separately. Why? Because the limit is applied at the individual level and not at the partnership or S corporation level. So so how do you enter them? It's easy. They'll give you a sheet. You enter them on the 4797 just like you would if it wasn't on the K1. Just remember that, okay? If you don't think lobbying rules or lobbying has power, right here, 1237. 1231.7 says, no substantial improvements that enhance the property held 5 years. Upon the date of the sale, you had no other real estate, which means we're not a real estate professional. You can treat it as capital gain versus like sublot if you're an investor or if you're a flipper or something. This very rarely comes into play. What a substantial improvement means essentially not more than 10% of the total value. So if you put in roads, utilities, things like that, that's probably going to give it a substantial improvement. Just know, right? Hold for 5 years, no substantial improvement that increased the value more than 10%. You don't have to worry about if you're a flipper or not. As long as you're not a real estate professional, it's considered to be capital gain, end of story, okay? How many people in here represent real estate professionals? Okay. Did you ever audit, sir, Mr. IRS agent? Did you ever audit real estate professionals? Okay. So, I mean, not even at the beginning or anything like that? Okay. If the IRS, if he comes in, he's going back into work for him because he's coming after me now. And he comes into who had the real estate professionals? They keep a log every year? Thank you. Who thinks that they're real estate professionals? There's a good friend of mine that Kelly Lampall, she lives up in upstate New York, and we do the tax forms together, and she taught. So during the 3 tax forms in ATP, we don't get to choose our topics, so she got the classifications of LLC. I got real estate professionals. So she called and said, AJ, I don't know anything about LLCs. Can you take it, and I'll take the real estate professional? So both of us were like, I was like, yeah. But, I mean, at the end of her class, you're like, maybe they're not real estate professionals more. Because, one, they have to keep a log, right? That's one of the things they look for, right? Just get different color ink pens. Just kidding, Mr. IRS agent, just kidding. So, all right, we got that. What else we got? Oh, the de minimis. Remember? January 1st, 2014, we got the repair regs, right? Betterment, adaptation. We thought these were the hardest things in the world. Now we could care less, right? We got so many things going on, right? Since the passage of the Tax Cut and Jobs Act, we haven't had a day off. I mean, it's kind of true. Now the sunset. Now remember this. Not an update class, but remember this. When your client comes and sees you this year, this is the last time you'll see them before the expiration of the Tax Cut and Jobs Act. What about people with kids? 2,000 down to 1,000. That 400,000 level is going to go down to 160. AMT is going to affect, instead of 200,000, 6.7 million. They might want to increase their estimate or change the withholding. Not an update class, but I just thought I'd throw that out. Why? Because we're talking about the de minimis, right? If you have the election, right, check a little box, do it whenever you want, you can elect to expense. So if you buy 10 printers that cost $2,400 each, you can take them all at once. But when you sell them, there is no capital gain treatment. They're all ordinary income. You put it on the 4797, right? Part 2. I think part 2, right? Oh, it's ordinary. But, so in other words, the client comes in and they sold 10 printers. But you can't find them on the depreciation schedule. Oh, we did the de minimis safe harbor. There's no basis because you wrote it off. Okay, it's not depreciation. You just include the sales price, and that's the gain on it. As simple as that. Okay? If you sold it for like $10,000, you just put $10,000. You don't put anything in for depreciation or anything. It's all ordinary. It goes on part 2, and away you go. How many, when you do the de minimis, how many put them in a separate category and call them de minimis, or do you just put them in office supplies? Does anybody list them separately? Yeah, but you keep, some kind of track. How many people do bookkeeping or financial statements? I was like, no kidding. How many do payroll? How many never take vacation? Same people who raise their hand. How many do sales tax, things like that? No kidding. God bless you. I mean, I don't know, I just do tax. No.
I was leaving it in income.
That's fine. Yeah, you can throw it. Yeah, you should. No. You can, but, you're paying for part of his retirement. I wouldn't do that. No, I'm kidding. I love you. Yeah, because don't put it on the Schedule C because it's not a 280 cap F recapture. It's just ordinary income as it would be 1245. So it should go on the 8949 versus the Schedule C, so you just saved. You just paid for your whole trip. So. No, I'm just kidding. But lawyers, who else represents lawyers? They are a rare breed, aren't they? I mean, it's kind of funny. How about doctors? So half of my practice is now, of the 50 clients, I think 40 of them are lawyers and doctors. They're just entertaining, right? And whoever, okay, so who's practiced less than 5 years? Anybody? Yeah, back there. You got to have thick skin, man. Just take your head every morning, pound it against a brick wall. That conditions you for the life that you're in store for. Because it's like clients, it's just like, I love clients who say, what do I owe? Because I get a commission on how much you pay. Because you didn't pay your estimates, you moron. So, how long have you been practicing? You haven't even started? What the hell are you doing here? Learning. Yeah, learning? Yeah. Just, are you?
I did a couple last year. But...
You did a couple? Yeah? A couple hundred or just a couple? Just 6 of them. All right. You're just starting. I mean, you're working for anybody or what? This is cool. Are you an EA?
No, yes, I am.
All right, congratulations.
I'm a financial planner.
Oh, fine, okay. But what perfect way than a financial planner who you have their trust and now you do their tax return. It's a perfect, I can hear myself back here. I don't sound good. Let me go back up here. So that is super cool. Keep doing it. You know what? Look around the room. We're all ancient. No offense to anybody. You got plenty of business, right? Just keep doing. Yeah, you're not that old. Okay? So, yeah, my son's a chemical engineer. Oh yeah. And you know what's interesting is if you look at the EA group, the second career are engineers. They're like, try like Beth Logan. You know Beth Logan? It's like trying to explain something to Beth. You're like, right? And she'll tell you that you're wrong, even though she's wrong. Like, Beth, how's that work out? Right? Yeah, my son's a chemical engineer. Just like, Dad, I got the K2. Well, okay, well, K1, but you probably did get you didn't get a K2, pal. So, somebody asked him what he does, chemical engineer. What's he do? He's in biofuel, where they just finished a project, a major home builder, and they took all the wood that they would normally waste, and they turn it into renewable energy, which then they can go off the grid. They don't have to pay for electricity anymore. So it's kind of cool. So I said, what are you doing now? And he goes, it's top secret. Like, I would be able to explain it to anybody. Yeah. Yeah, you know. And then his sister is a teacher, is a second grade teacher. So she's got the most important job over all of us, you know, but then makes crap. That's why she lives at home. She told me the other day, I was like 10:30 at night, I was taking a piece of cake. She goes, Dad, is that a good idea? I'm not one of your students. I don't give a crap, right? I'm going to have the cake. I am not one of your students. Anyway, other issues. 1245, this is a software issue. Oh, by the way, young lady, what's your name? Sorry. Okay. So what's cool about your depreciation schedule? Oh, you had to get somebody else's depreciation schedule. Anyway, yeah, that probably didn't help. But your depreciation schedule, the way you kept it, would have been great for 751, but then you had to get somebody else's. Never mind. 1245 recapture is QBI for 199A, but you got to tell your software that. Good luck with that. Good luck calling the programmer. How come it's not working out, sir? It's not yet. It is. Unrecaptured 1250 is not. 1231 gain is not. Why? Because they get preferential treatment. 1231 losses reduces. Please remember this. How many think that their software does the QBI calculation correct? Self-employment tax, health insurance, charitable contributions, 1231. I've seen where 1231, they've added it on somebody, on it, not on the software I use. He's retired. What are they going to know? No. It's
We're going to lose it in another year anyway.
Yeah.
So.
You know what I'm interested in seeing off the cuff is the pass-through entity tax, or the SALT cap, right, is well, that was a fundraiser, right? Everything's revenue neutral. So then they passed 2020-75 and let the PTET come into play, which is a revenue loser. So I would imagine, I don't know if all of you would agree, that PTET is going to stick around, that you can do it, but are they going to allow it? But there's been so much work, I don't think they're going to change it. And why would you? It's a great deal to have pass-through entity and to do that. So, all right, now we got this thing back up here again. Remember, 1231 asset held more than a year. Trade or business. Is it a loss? If it is, boom, you're done. It's ordinary, fully deductible. Is it a gain? Yep. Was there a previous 1231 loss? If there is, then you recategorize that portion. Any remaining gain, is it 1245? All the depreciation taken is ordinary income. Any excess is 1231 capital gain. If it's 1250, you do the same thing. These charts are here for a reason because sometimes you cannot let the computer do everything, right? You can't assume these. Anybody dealt with these? Anybody dealt with these? That's why we're not going to talk about them. But I have dealt with all of them, but I've been practicing probably 37 years, and that hasn't happened very often. But we do have other types of property you got to be concerned with. Who does represent farmers? Yeah, yeah. But a couple of them, or just a few of them, or just a couple? Okay. Anybody here from New Jersey? Oh, okay. Well, shut your ears for a second. So I was in New Jersey at a governor's conference, and some smartass says, "What's in Iowa?" And I said, "Every meal you eat." Didn't think that was funny. That was a Northeast governor's conference, but yeah. Don't shout out if you don't want to be shouted back. All right, let's get into some planning. Tax treatment, assets sold, seller's treatment, buyer's treatment. What do we have here? This is important. Right? Somebody comes and they're going to buy out your client. Well, how it's allocated is probably one of the most important things of how we earn our money. I remember negotiating recently with a big firm, and they're like, "Why wouldn't you want it the way we wanted it?" Because it doesn't help my client any. This is a neat little chart. Keep this chart, because I like it. I mean, I designed it, but it's kind of cool. It's at 1245, seller's treatment. We got to recapture ordinary income. But you want, if you're buying something, you want everything 1245, even a building. Can we put $1 on the building? No. Right? Land. We want to put more value on the land. The buyer doesn't want to put any value on the land. Inventory. Inventory is kind of black and white, I think. I mean, it's you get somebody coming in and you evaluate the inventory, and away you go. Maybe you can add some value to it. I think inventory is something that confuses people when it's sold, because they're like, well, there got to be an ending inventory. No, you don't. You sold it. How is there an ending inventory? Right? That's why I always say, look at the journal entries. Journal entries solve the majority of our problems. Goodwill, client list, right? Amortized over 15 years. Recently, another practitioner got audited that bought a practice, and they got audited for another reason, but they had paid this person their list. They just wrote it off as commissions versus, it's a client list, but they were like, because they paid like, whatever, 50% 1 year, 25% 1 year, and then 50, whatever, to people, but they just wrote it off, they didn't amortize it. Covenant not to compete, right? Seller's treatment is ordinary income. It's not subject to self-employment tax. These things, when you negotiate, you always want everything detailed out to the best of your ability. Why? I'll explain a little bit. Okay, does anybody know what's going on with covenant not to compete? The Federal Trade Commission came in on a 3-2 vote and said covenant not to compete is illegal. It's no longer valid. Just hold tight. Which means what? Mary, you're ready to retire. Just saying. You sell it to me. You're like, AJ, I want X, but I want a covenant not to compete. I'm not giving it to you because it's no longer legal. I love it. So if you're in like an employee, an employer, they have a non-disclosure or covenant. If you're a senior executive that made $151,164 over that, then it still stays into place, but going forward, you can no longer have it. Well, there's a lot of things wrong depending on what side of the fence you're on. The Federal Trade Commission in their ruling 3-2 says that it will promote businesses. But the two people that dissented said, it's going to hurt because, Mary, you bring me in, right? Bust my butt. You teach me everything. And you're like, wait a minute, you signed, but it's no longer valid. That hurts you, right? So you got to be careful. But, all right, so there was a case in Texas. Texas Chamber of Commerce sued and said that the FTC exceeded its authority. And the courts agreed. The federal court in Texas agreed that the Federal Trade Commission exceeded its authority. However, the federal court took one step that was very surprising, and they said it only applies to this case. So right now, it only applies to that particular case. So it'll be interesting to see how many other cases. Very similar to, everybody knows and everybody loves the beneficial ownership information, right? So the 11th Circuit just was heard down in Alabama, and the National Small Business Association, and the briefs were heard September 24th, their argument was weak. They should be embarrassed. It should be embarrassed they even went that far, but their argument was very weak. In the Firestone case in Oregon, the judge told the people that brought suit, if this is all you got, have a nice day. I'm not hearing the case. The CTA is not going anywhere. Federal Trade Commission, the covenant not to compete, I don't know, but I think it might eventually get overturned. But right now, other than the Texas case effective September 4th, which was 60-some days after it was written, the regulations were written, are going into ban. So technically, you cannot negotiate a covenant not to compete as we stand right now because it's not worth the paper it's written on. How that's going to turn out, please stay tuned. That's where we at. Yes, sir.
Is this a ban going forward?
Yes.
Period.
Okay, it's a ban going forward, and essentially, unless you're a senior executive making more than $151,164, it stays into effect. Otherwise, everything else is void. Okay? That's a tough one. 3-2, so it wasn't like a yippee-skippy, type of deal. It was, yeah. Stay tuned. So, oh, sure. The client at the end of the day is whatever right, yeah. They choose me, sorry, Mary. They'd be walking right out with me. No, I don't know until you get on there and start honking your horn, then you get them all back, getting them on back there. Okay, I love this. Any other questions on tax planning and how you should or how you shouldn't or anything like that? Allowed or allowable, right? What does that mean? That means that you have to take, so depreciation is assumed to be taken whether it's taken or not. Can you, not a funny story. A lawyer calls me and he says, AJ, I have this guy, 23 rental properties, not an LLC. I don't know what the other accountant is doing, but oh my goodness, can you look at it? I'm like, oh, for the love. So I looked at it. So I called the other accountant and I said, hey, can I get the depreciation schedule? He goes, I don't have any. What do you mean you don't have any? Now, remember, this is Iowa, so what these guys did, or what him and his wife did, is they bought properties under $30,000 that were about ready to, and then they fixed them up and turned them into apartments. He goes, this is a true statement. He says, I went to some class and talked about depreciation recapture, so I just wrote everything off. Okay. Mike wrote everything off. What about land? Okay. Wow. 23 properties. How do we fix that? I'll tell you in a second. But somebody approached me. So I consult for one of the top 15 CPA firms in the world. Kind of cool because they got a lot of resources. I just get lucky at these things. So they came to me and they're like, can you choose to take depreciation or not take it? Say we're not going to take it, but we can fix it by using the 3115 in a little bit. Can you do that? Let's have like a Frank. Like, is it ethical or unethical? So I'm choosing not to deduct it, so my income is higher for whatever reason that will assist in getting to have other losses offset or whatever the case might be. Right? It's deemed to be allowed or allowable. So it's deemed that would have been, I can correct it with the 3115 later and bring it in under a 481 adjustment, which I'll talk about briefly. Can you do that? Required revenue 56. You want to write this down. This is not in your presentation because I don't put everything in it. I got to leave a couple tidbits so you're paying attention. Revenue ruling 56-407. 56-407 states a taxpayer cannot choose not to claim a deduction. Knowing a deduction is available and not claiming it would be a violation of the revenue ruling. Okay? The opportunity, I'm just going to read my analysis because I just did an analysis on a case. The opportunity to correct the missed depreciation deduction means taxpayers do not permanently lose this tax benefit. That's the 3115, which we'll talk about. However, it could result in some taxpayers not claiming depreciation in a year when they have low income so they can fix it later when their income is high. This revenue ruling was written, even though in 1956, to not allow such a thing. Substantial authority. Revenue ruling is a substantial authority. So they can't choose. And this other national firm, not the one I consult with, they do it all the time. This one partner said they do it all the time. So I found this ruling because it was a fight back and forth. But qualified improvement property, we all loved it. Tax Cut and Jobs Act was passed, gave us 15-year property. We could use bonus on it. However, it was not written well. You know what's interesting on that is if you look at substantial authority, one of the substantial authorities says congressional intent. The congressional intent was to give it 15-year property, but the code was not written properly, and the IRS came in and said, no, we don't care if it's congressional intent. But I would have loved that to have been challenged, but anyway, it fixed it. So now what was 39-year property is now 15-year property. Some people say, I don't want to fix it, because technically the IRS is getting a good deal. The problem with that is if that property is sold inside of, let's say, 20 years, it's deemed to be fully depreciated because it's allowed or allowable. Make sure you go back and look to see if you had any 39-year property that technically should be 15-year property. It has to be the interior portion of a non-residential building of which was not attached, so when you removed it, did not cause damage. Costs segregation studies, like we talked about. You have to understand, is it worth spending the money to go in and get it analyzed? Cost segregation studies are a very important item to help get the depreciation accelerated. Don't forget 179 depreciation, residential property. It's allowed in certain aspects. Non-residential property, there are certain things that are allowed under the Tax Cut and Jobs Act. Don't forget about these little things, right? Roofs, HVACs, fire protection systems, alarm systems, security options are all part of that 179. Try to tell your software when you tell it it's $1,250 and it's eligible for 179, your software is going to tell you, no, it's not, but you got to check a few boxes. Partial disposition. This is pretty interesting. Who's done one of these recently? Well, here we go. What are we doing up here? There you go. So, what happened to the previous one? Took it off, right? Yeah? But when you originally bought it, didn't it have one on that you were depreciating it? So now you're depreciating two of them? No, under the partial disposition rules, you get to take off the percentage, a portion of this previous that had never been fully depreciated. Even here, right? Enter the total amount of loss included in line 2 and 9 due to partial disposition of makers. Here are the details that you need to know. Any reasonable method, right? How do you determine you bought a building for $390,000, you broke it out between land and the building. But what's included in that building? A roof. So you got to then determine, you can either do it through cost segregation, any type of reasonable analysis is allowed by the IRS. Replacement cost. How do you figure that? Call your insurance agent. Okay? And then you break it up into a sub. So if, let's say you had depreciation and you figured that 10% of the price, 10% of accumulated depreciation, and you can write off what was remaining on the previous one that you just replaced. It's a big deduction here. Okay? It's a big deduction. If you miss depreciation, don't forget about using 3115. When you have an inappropriate accounting method, it's something that's been used on 2 consecutive returns. Code 7 means you missed it, or 107 is the year of the sale. House flipping. Remember, you either have an investor or a dealer. A dealer is like having inventory. They are Schedule C, self-employment tax. Even if you flip 1, or even if you flip 99, I can show you a case that he was an investor because it was not part of his main course of business. Don't forget about the settlement statement. There's a lot of goodies on that settlement statement that you deduct or don't deduct or have to amortize or have to, right? Loan fees. Why do you want to amortize? Why do you want to put them with the total basis over 39 when you can do them over the loan of 15 or 30? Last but not least, the basic choices of how you allocate a sales price. No matter how you do it, when you put it on the depreciation schedule, you can do the total opposite. One of the things that is allowed is the assessor statement. Now, if the assessor says $20,000 is land and $100,000 total, that's 20%. So you take 20% of what you're going to sell it on. Any agreement between non-related parties is substantial authority. Don't forget that. Basic choices. And you know that because you got to file the 8594. You have to break it down. The majority of the stuff is right here under 5 and 6. Time for break. Get out of here.
That was awesome. Wow.
Thank you.